The Iron Butterfly option strategy is the best strategy whenever it comes to risk versus reward. You can make a whole lot of money without having to put down a lot of risk. For example, the other day, I ended up risking just $237, and by the end of the day, those options had gained $315. But for full transparency, I ended up losing $3 on these options because I didn't hold it to the end of the day, but at least it's nice knowing that I could have made $315. The Iron Butterfly is very similar to both an Iron Condor and credit spread. So whenever you're trading credit spreads, you're assuming that the stock is either going to be above a price if you're doing a put credit spread or below a price if you're doing a call credit spread. And then in Iron Condor is the combination of both of these to where you're assuming that the stock is going to be between two strike prices. And finally, with an Iron Butterfly, you're pinpointing a single price that you think the stock is going to be at the end of the trading day. And this is what makes the risk reward ratio so damn good, is because it's very difficult to pinpoint a single price that the stock is going to be at the end of the day. But the way that you're going to set this up is you're going to have a range in mind like you would with an Iron Condor. And then from that range, you're going to determine if the stock market is bullish or if the stock market is bearish for the day. And you're going to use this sentiment, bullish or bearish, and the range in order to pinpoint a specific price level that the stock market is going to end the day. For example, this morning, SPY was trading between $395 and $397 after the Michigan Economic Report came out. And I was assuming that SPY would trade flat for the rest of the day. But I was slightly bullish because the Michigan Economic Report was good. And then earlier in the day, we had another report that also came out somewhat good. So I assumed that the stock market would trade flat, but it would be slightly bullish. So this led me to pinpoint a price that I thought the stock would be at in that $395 to $397 range. I figured that it would be at the top of that range at $397. So I sold both a $397 call and a $397 put, the pinpoint price that I wanted it at, and then I bought two options against those options that I sold. So I bought a $395 put, so that was the bottom end of the range that I assumed SPY would be at, and then I bought a $399 call, or the upper limit of the range that I thought SPY would be at for the day. So to recap, I assumed that SPY would end at $397. I sold a $397 call, $397 put. I bought a $399 call, and then I bought a $395 put. So I had a $4 range that I thought SPY would be at during the day, and I was assuming that SPY would end the day at $397. For this trade, I ended up getting paid $137, and I was only risking $63, or the collateral for that trade, which was $200, or the difference between my call strike prices and my put strike prices. And then the risk was the collateral, $200, minus the $137 of credit. So my risk for this trade was $63, which meant that my risk reward ratio was better than 1 to 2. And that's the beauty of this strategy. You don't have to risk much money and you can make a lot. But I haven't really fully explained how the strategy works, so stick around. The first thing that you're going to do in order to set up the strategy is you're going to pinpoint a single price that you think the stock is going to end the day at. So like I assume SPY would end the day at $397. So the first step for the strategy was selling a $397 call and then a $397 put. So my assumption was that SPY would be at $397 at 3:59 p.m. on my expiration date. So I sold a $397 call, a $397 put, and then I chose a range that I thought that it would end the day between. So what I did was I used that bottom $395 limit, and I thought that SPY would end the day above $395. So I bought a $395 put. You're going to buy a lower strike price whenever it comes to the put option. And then I assumed that SPY would probably end the day below $399. So I ended up buying a $399 call. So the way that we structure this is we sell the strike prices, a call and a put, that we think the stock is going to end the day at exactly the pinpoint. And then we're going to buy a put option with a lower strike price, the lower limit that we think the stock is going to be in a range. And then we're going to buy a call option with the higher limit of that range. So I assume that SPY would end the day between $395 to $399, and I chose specifically the $397 strike price to sell. And whenever I opened this trade, like I said, I got $137 of credit, but that credit wasn't free. I had to risk some money in order to get that credit. And the money that I risked depended on the strike prices that I chose. So again, I had a $399 call that I bought and then a $397 call that I sold. So we take the difference between those call strike prices, which was $2, and we multiply that by 100. And that's how much collateral that we need in order to put this trade on. And the same goes for the puts. Since I bought a $395 put and then sold a $397 put, the difference between those strike prices was $2. We multiply that by 100, and we're using the same $200 of collateral that we used for the call options. So the collateral that you're going to put up is going to depend on the range that you have for the stock. So for me, this was a $4 range. We divide that 4 by 2. That gives us $2, and then we multiply that by 100 for the shares that we're controlling. So $200 of collateral in order to open this trade, and I got $137 in credit. So in order to come up with the max loss or the risk for this strategy, we're going to subtract that $137 of credit that I got from the $200 of collateral that I'm putting up for this trade, and my max risk for this trade was $63. So you're going to take the collateral minus the credit that you received to open your Iron Butterfly, and that is going to be your max loss or your risk whenever you're opening a Iron Butterfly. So for me, I ended up risking $63, and my max profit for this trade, and the max profit for any Iron Butterfly, is just going to be the credit that you receive. So for me, this was $137. So I risked 63 to make 137 for a better than 1-to-2 risk reward ratio. But you can end up losing a whole lot more than your max loss, and you could be on the line for hundreds of thousands of dollars. This is what's known as pin risk, and this happens whenever either both of your call options or both of your put options are in the money at expiration at 4 p.m. and then the stock moves after hours to where the short call or the short put, the one that you sold, becomes out of the money. So what happens here is whenever both of the options expire in the money, your brokerage is going to start assigning the short call or the short put, and then it's going to start exercising the long call or the one that you bought or the long put. But then whenever the stock moves after hours to where the short call or the short put is out of the money, then they're going to cancel the assignment because it doesn't make sense to exercise or assign that option anymore because it doesn't have any intrinsic value. So this means that you're going to be left with exercising the call option or the put option that you bought. And if you're exercised on a long call option, that means you're going to have to buy 100 shares of the stock. And if you're exercised on a long put option, you're going to have to sell 100 shares of your stock at the strike price that you chose. So this means with my $395, $397, $399 Iron Butterfly that I had set up, if SPY ended the day, say at $397.50 at 4 p.m., then Robinhood would have started to exercise both of the put options to where I would be buying 100 shares of the stock at the $397 strike price and then selling those 100 shares at the $395 strike price. But then if SPY ended up moving after hours, say to $396.75, they would have canceled the order to exercise the $397 put. Meanwhile, the $395 put that I bought would still be in the money to where I need to exercise that $395 put to sell 100 shares of the stock at $395. This means that I would need to buy 100 shares of SPY to sell it at $395. And I had 4 of these spread options open. So if SPY was trading at $396.75, then I would have needed to buy 400 shares of SPY worth around $159,000. And I don't know about you, but I don't have $159,000 to give to Robinhood. And since I don't have that money, Robinhood is going to put my account in a deficit to where I owe them that $159,000. And I know this all sounds terrifying, but there is a super easy fix for it. And Robinhood actually has a built-in fix for it to where this shouldn't happen to you. Because Robinhood closes any type of spread option where you're buying an option and selling an option in the same order at 3:30 p.m. on your expiration date. But not every broker does this. So you need to make sure that you're closing an Iron Butterfly before it expires. So you need to close this Iron Butterfly by 4 p.m. Otherwise, you could be on the line to buy hundreds of shares of the stock. And for my example, this would have cost me $159,000. But like I said, Robinhood will close this order for you most of the time, but you always just want to make sure, because being on the line for $159,000 would absolutely terrify me. And those are all the risks that I know for the Iron Butterfly. That's how the strategy works. I gave you an example for reference for the strategy. So hopefully this video was useful. If it was, show some love, leave a like. Thanks for making it all the way to the end of this video, and thanking all my patrons for their support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys. We're better prepare for when I'm a billionaire.